Okay, welcome to your first video lesson. This is related to the very first tab on the assignment. So if you open the Excel template, you will find that this is the first tab. And if you look generally down at the bottom, you're going to see there's three purple tabs, and those tabs relate to the roasting segment of the business. And there's also three red tabs, and that relates to the cafe part of the business. So I'm going to do a video for each task. Try to keep the videos fairly short, as short as I can, and still give you the information you need so that you can make your way through the assignment successfully. What we're doing, let's kind of review where we've been, where we're going, what we're doing now. Uh, in our first Excel assignment, we looked at 8 years worth of data. We computed all of the various financial statements, income statement, balance sheet, statement of cash flow, statement of equity. We did ratio analysis, and we interpreted the performance of the firm over time. So we'd say a time series analysis of the company over that 8-year period. Then in the second major task, we looked more deeply at 2019. We looked at the three various segments of the business, and we isolated the exact amount of loss that we were incurring in bakery. So that was a new piece of information for us. We had a suspicion we were losing money in the bakery, but we weren't really sure exactly how much. So we were able to isolate that for 2019. We were also able to calculate unit costs. So we know how much it costs us to produce a pound of coffee or to bake an item, right? So that is also extremely useful information. So now we've got a better handle on our profit margins on each unit that we sell, and we're well on our way to being able to answer complicated questions like, well, how many of those units do I need to sell before I break even? So that's where we're headed in this assignment, is to give us a little bit more structure so that we can sort things out even more. So we got to go into more detail, drill down even deeper so that we can sort out the costs and be able to ask those kinds of questions and get answers. So we're going to take it in two phases. Lesson 6, basically we're just going to sort out the costs. And then in lesson 7, so next week, you're going to be able to figure out how many units you got to sell to break even. And we'll play around with that bakery price so we can figure out, what do we have to charge to be able to break even, and whether or not we believe we can do that. So we're going to be getting into some really cool stuff, and I hope you're excited to continue learning about managerial accounting information. So looking at this first tab, what you have is January through December. You have quantities and you have unit prices. So let's take a deeper look. This first cell here is the number of pounds of coffee, this is quantity, that you're selling to both wholesalers and the cafe. If you remember from our last lesson on the cafe tab, we calculated, I think, if I remember right, it's around 60 pounds a day is what we forecasted. It's like 57 or something like that. And the rest is going to be to the wholesalers here. And then we also have that retail market where we sell coffee online. The prices we charge for these two markets are different. So I've got those prices down here. I'll get to that in a minute. So that's why we have to separate this out, why we can't deal with this in grand total. We have to separate them out only because the prices are different. All right, so then I've got down here, so this is total, right? It's just a sum of the two areas. Here is the number of days per month, right? So notice that in December, we're down to 24 because there's a week of the year that we're closed and it's around Christmas time. And that's where that 358 days is coming from. So we're going to be short there in December in terms of sales, and you'll see that show up. All right, so what do we do to get this number? This is just the 88 times the number of days, because these are sales per day, and this is the number of days a month. So I'm just multiplying through and extending it out, so for both wholesale and retail, and then adding those together. So I got my total volume there. Okay, so this is the price for the wholesale, this is the price for the retail. So I'm going to now extend that out. Quantity for wholesale times price. And I want to do the same for the retail. I can just drag that down, and then I want to take that whole thing and drag it over. Okay, so that's the monthly sales for the two segments that we have within this operation. And you notice over here, I gave you this hint. That's the answer you needed to get, and that's exactly what we got. There's a couple other things here that should stand out to you. One is this average price. I'll come back to that in a minute. That should look familiar to you. We calculated that in the roasting tab as being the average price that we charged for a pound of coffee. And you can see it's right in between these two. And it's a weighted average price. So I'll show you how to get that in a sec. Let's look at this. So this is the weight, the percentage of the total sales that we would attribute to the wholesalers. So you take that 26, divide by the grand total. So 61% of the total. And do the same thing here for retailers. Take the 17, divide by 43. So these two, of course, have to total 100%, right, of your sales. So it's telling you the percentage breakdown. And if you take that over here, this column is giving you the average for the entire row. So the average for the year is about 62% of our sales are in wholesale and cafe, and 38% of our sales are retail. And so that's how you get this average price. Right? This is for the year too, right? Same thing, same calculation. So what we do is take the 960 times this percent, because that percent of sales are at that price. And we do the same thing with the 1670. So we multiply that times 38 and we add the two together. That's called a weighted average price. So you don't just average these two. You can't do that because the quantities are different, right? So let me do that for you so you can see that it's different. So the average of these two prices right there is $13.15. You can't take that as the average price because the quantities are different. The only time you can do that is if these quantities were exactly the same every single time. Okay, so if the average was exactly the same for both markets that you serve, but they're not. So you have to calculate that based on the percentage of sales. But that is called a weighted average. So that's where that's coming from. And then these are weighted quantities, which we're going to need for a couple of reasons. One, we want to be able to work in by looking at one weighted average quantity. So we've got, makes life a lot easier for us when we go to calculate things like break-even point. And then if you want to split it back out afterwards, you can easily do that by using these sales mix percentages. Okay, so we'll get to that. That's in the next lesson. So right now, just trust me, you're going to need this. So how do you get these weighted quantities? You take the total sales and you divide by the weighted average price. And that would give you a weighted quantity, which is what you calculated when you determined the number of pounds of coffee sold in the last assignment. That was a weighted average number of pounds. And it was a weighted average price. Okay, and when you calculated the cost in the last assignment, which was $9.41, that's a weighted average cost of these units. So to get these to run out, to get this total cost of goods sold down here, we will have to use the weighted quantities, okay, to get these to run. Otherwise, this would not balance out with our cost of goods sold that's on the income statement that you have from the last assignment. So for this, let's look at it. That was the cost that we had determined for a pound of coffee, and it consisted of $4.77 of direct materials. That was the cost of the raw beans. $2.49 in labor, direct labor to roast the beans. And then I split this out for you. The variable manufacturing overhead components, what I picked up here is strictly the cost of the indirect materials, which is the bags and the labels. Okay, so that's what that cost us, was 53 cents for a bag and a label for a pound of coffee. And then the rest of the overhead, I want you to think of it as being fixed. So this would be the depreciation, the insurance, and things of that nature that were pulled into manufacturing overhead. So trying to make this as simple as I can and hopefully meaningful. So the only thing I pulled out was the bags and the labels, and the rest of it, I'm going to consider it fixed, committed that we have to incur those costs. Okay. All right, so to get your cost of goods sold, the first part's super easy. Just go grab the fixed, Notice it's the same amount every month, and that makes sense because fixed costs are fixed. They don't change no matter how many units or pounds of coffee we sell. To get the variable cost of goods sold, you're going to have to add the direct materials plus the direct labor and the variable manufacturing overhead, and then multiply that by the weighted average units. So again, why am I using weighted average and not these actual units? I'm using weighted because this total cost and these figures that were given here were based on the weighted average number of units when we did the calculations in the last assignment. So this is apples to apples right there. Run that out. All right, so we are a little bit short. We're $109 off. It is due to rounding because I'm calculating these weighted average figures and I've truncated some of the decimals. I'm not worried about it in the least. So that's close enough right there. So we're off approximately $100. If you look at gross profit margin in total, this is the weighted average price minus the weighted average cost. And if you divide that, so take the 290 and divide by the price, you get gross margin, just 24%. Hopefully that rings a bell. If you go back and you look at your segment data that we did in the last assignment towards the very end, the new gross profit margin after we brought up all the costs was 24%. And this is in total dollars. So this is an average again. It's the cost of goods sold minus the sales, right? That's gross profit. And then you take that, divide by sales to get it as a percent. So either way you do it, you're going to get the same rate. And that jives with what we had before. Okay, so that's the end of task 1. Get that far with it. And then as soon as you feel confident with that, go to task 2. So there's another video for that. Thank you.